All right, everyone, welcome back to Ryan Miller Trading Economics. This is the first full video breakdown. We're going to get into the equity indices, figure out what the hell is going on. Is the move the last couple months to the upside, is it warranted, or is it not? So that's what we're going to try to figure out. Okay, we're going to break down the fundamentals and figure out, has the economy bottomed? Is that why stocks are moving higher, or is this move higher irrational and it's going to roll over? All right, so we're going to get in depth into the data. So this video might be a little longer than a lot of the other ones going forward, because we're not going to have to dig into all the pieces of data every week, because they're not going to change that much. Okay, so I want to build a foundation first of a lot of the data points we're going to be looking at, so we have a good understanding of where the economy is, where it's headed, and then we can go from there. All right, so let's get into it. So just have the equity indices here, major ones: Russell, S&P, NASDAQ, the Dow Jones. As you can see, they've been, last couple of months, they've been moving higher, right? I think that Russell's up like 22%, S&P is up almost 19% in the last couple of months. A lot of people are saying this was the bottom in stocks. Economy's bottomed. Stocks are heading higher, and they may be headed higher, but they headed higher for the long term, or is there more downside first? That's what we need to try to figure out, and that's what we're going to try to do. So let's get into the data. So we need to define where the economy is right now, and we do that, if you remember from the framework. If you haven't watched the framework, go and do that. Fundamentals, technicals, how to put it all together so you're not lost. But if you remember how to do that, we have to look at the coincident data first. That tells us where we are. So if you look at the four major components of the economy: income, consumption, production, and employment, that defines the trend, where we are right now. So for real personal income, excluding current transfer payments, as you can see, headed lower. Started to slow in April of 2021, and been heading lower ever since. Real consumption, same idea. So both income and real consumption are nearing that zero bound, right? Outright contraction, right? Industrial production, slowing as well, right? Continuing to show signs that it wants to head lower. Look at it. Employment, non-farm payrolls. This one has held up the most. Employment is the most lagging of the four, so it's no surprise to see that. Employment usually starts to go when recession is right on the doorstep. So that one's held up the most, but still slowing. Right? Still slowing. Now we would put all four of those together and take a look at them into one index. It's been slowing. Right? It's kind of stalled a bit. Been slowing though, and we're headed towards 3%. Growth. Now, this is what the NBER, National Bureau of Economic Research, looks at. We look at income, consumption, production, and employment. Now, two other indicators that they look at, aside from non-farm payrolls and real consumption, is real retail sales and employment level. So if we were to use those as alternatives to employment level, as an alternative to non-farm payrolls, and real retail sales as an alternative to real personal consumption, and put those into an index, right, combined with industrial production and real personal income, growth is 1.3%, or much closer to that 1% level. So the economy is clearly headed lower, right, or has been heading lower towards that 1%, towards that 0%. And as the economy gets into that 1% range, it becomes a lot more vulnerable to a recession. Okay, so that's where the economy is. Is that where it's going to continue to head south? Let's find out. The way we do that is we go to our leading indicators. First, let's look at some longer leading indicators, right? Some monetary aggregates. So if we look at the Fed's balance sheet plus the monetary base, it is headed lower, much lower from these very high levels. We're nearing that zero bound. Okay, now a lot of this liquidity, right, that was put into the system from that March 2020 recession got trapped in the financial system, but now that liquidity is exiting the financial system. Okay, and at the same time we saw that in risk assets and stocks trending lower. Okay, this is a longer leading indicator. No signs that it's bottomed yet. We look at the same time, we have real M2 also heading lower, contracting at a almost 3% annualized rate. Okay, now this represents mostly depository accounts, right, of consumers. So when this line's going up, it means capital is getting into the accounts of consumers. And that's important because the private sector drives the economy. That hasn't been the case since middle of 2021, right? We're now contracting, no signs that it has bottomed. At the same time, we have rising interest rates. This is the most rapid rise in interest rates since the early 1980s. So this is mortgage rates, treasury rates, and corporate rates. Very rapid rise, fastest since the early 1980s. Okay, now let's assume, and this is a longer leading indicator. Okay, now let's assume that this is the top for a moment. That rates have topped here, and they're going to trend lower in the future. So if this is the top, this being a longer leading indicator, giving us an 8 to 12 month lead time, that suggests that the economy is going to continue to slow into the summer of 2023. Okay, if this is the top, it could still move higher, right? So this represents private borrowing costs, and we've had a rapid increase. Longer leading indicator slows down the economy. Now, as interest rates fluctuate, they impact housing and construction. Those are one of the first sectors that get impacted by interest rates, housing and construction. And that's why housing is a good longer leading indicator, because it's impacted by interest rates very quickly. So if we start to take a look at some construction and housing data, we can see total construction spending. This is real construction spending. It's been trending lower, right? We're at these very high levels back in the middle of 2021, been trending lower since. No signs that it's bottomed. If we look at private residential fixed investment, which is housing, and then personal consumption, durable goods, right? This is your economy in a nutshell right here, housing and durable goods. And this is what drives the cyclical economy, because housing and durable goods is very volatile and has a high multiplier effect. So it drives the economy. And this is housing and durable goods as a percentage of GDP. And this has slowed down. These sectors have slowed down, leading into every single recession. So there's no recession without housing and durable goods slowing down. And here we are, again, slowing down. Longer leading indicator. If we look at some more housing data, the ISM manufacturing index, right? I'm sorry, this is the MBA purchase index, which measures mortgage applications, been trending lower, right? Much lower. Peaked towards the end of 2020, been trending lower ever since. No signs that it's bottomed. We look at NAHB housing market index. Okay, this measures sentiment amongst home builders. Headed lower, much lower, I believe, contracted, right? Under 50. It's not a good sign. Okay, headed lower, no sign that it's bottomed. Building permits, longer leading indicator, has slowed, has started moving lower. Housing starts, which measures new residential construction. Slowing and heading lower, no signs that it's bottomed. New home sales, so this is an important one. New home sales drive the economy. Those in real estate might be confused by that, because existing home sales is 90% of real estate sales. But home sales are what drives the fluctuations in GDP, because home sales have a much larger multiplier effect. Okay, so in order for there to be new homes, there needs to be construction, okay, which requires labor, requires materials. And when a new home is built, someone moves into it, they buy new appliances, new furniture. That requires a manufacturing process, which shows up in new orders, manufacturing new orders, which we're going to take a look at in just a second. Pending home sales have been plunging, contracting below zero. Pending home sales lead existing home sales, and those have also been slowing. Okay, so this is important. to look at these longer leading indicators, especially housing, because as housing goes, the economy goes. Housing leads us into recession, meaning you're going to see housing slow before we enter recession. And during the second half of recession, you're going to see housing market turn up. You're going to see these indicators turn up, and they lead us out of recession. Now, none of these indicators have turned up. They are all slowing and pointing downwards. So that tells us the economy has not slowed. And these are longer leading indicators. That tells us that the economy is going to continue slowing well into 2023. That's what all these longer leading indicators are telling us. About 10 or 11 of them here, all pointing down with no signs that they have bottomed. Okay, that tells us the economy is going to continue heading lower over the next 8 to 12 months. Now, what's happening in the shorter leading data, okay, which gives us 2 to 6 month lead time? Maybe that's why equities have turned up. Maybe the shorter leading data has turned up. So once housing slows, right, housing drives manufacturing, right? If housing's turned up, then there's going to be demand for those big ticket items, those durable good items, and then manufacturing is going to pick up and vice versa, right? We just saw housing's in a slowdown, and we should see that flow into manufacturing. So here we have the ISM manufacturing index, the PMI, and measures the level of manufacturing activity. Peaked here in 2021, but been slowing ever since. We are still above 50, so we haven't started contracting yet, but we're slowing, we're decelerating at a slower and slower pace. ISM manufacturing prices paid. This just plunged recently, last month. So this is clearly slowing sharply more recently. So if we look, it had been slowing down, and then it plunged into July. Prices paid. So if there's more demand for durable goods, in the manufacturing sector, their prices are going to rise. Well, they're starting to slow because business activity, manufacturing activity is slowing. Okay. Manufacturing supplier delivery times. And when there's strong demand and activity in the manufacturing sector, well, it's going to take longer to get product, right? Delivery times are going to increase. And we see that it's consistent with cyclical upturns. When we're cyclical downturns, when manufacturing activity slows, well, then supplier delivery times are going to slow, and that's what we're seeing. Above 50, right? So still growing, but at a slower pace. ISM manufacturing new orders. We are below 50 for 2 months in a row. So we're outright contracting in new orders for 2 months in a row. Okay. Now, if we look at ISM manufacturing less inventories, I don't have a chart for this, but I do have some data. So if we look at ISM manufacturing new orders, so back in May, it was at 55.1 relative to inventories, which are at 55.9. New orders were minus 0.8% relative to inventories. In June, new orders dropped to 49.2. Inventories went up to 56. So now there's a minus 6.8% difference in new orders relative to inventory. And that's important because as new orders contract relative to inventory, that's going to slow down production. Okay, and that's the phase that we are in the economy right now, is the slowdown in the production phase. Okay, which as production slows down, it's going to drag employment down with it. You're going to see unemployment rate rise. Now, employment is a lagging indicator. So you don't, like I said, you don't see that until recession is right on the door. But what you start to see first is a slowdown in, well, we haven't got there yet. Slowdown in manufacturing hours. Okay, which we're seeing. It's not a significant slowdown, but it is a slowdown. Right? Because as production slows and there's less work to do, companies don't just right away start laying people off. They cut hours first. So hours leads not only income, less hours leads to less income, but less hours leads employment, right? So companies, they cut hours first, and then eventually they go to layoffs. And that, as all the leading indicators continue to tell us the economy is going to slow, I expect unemployment rates start to rise probably by the end of this year. So if we go back to some more new orders, so if you look at manufacturing new orders, capital goods. So this capital goods are used in production, like buildings, machinery, tools, equipment. Okay, so this is real capital goods, new orders, not including defense, because that's not cyclical, contracting at a 8% annualized rate. We look at manufacturing, new orders, durable goods. This is real new orders and durable goods market, right? We're deflating by the PPI, producer price index. We are outright contracting by 6% annualized rate. This is consistent with growth slowdowns, and we see it happen before we enter recession, right? We get a slowdown in housing. Well, first interest rates rise, we get a slowdown in housing, which then filters through to the manufacturing sector, and then ultimately leads to recession, assuming the economy doesn't bottom, right, before we get to negative growth. And that's where we are headed right now. So we have 1, 2, 3, 4, 5, 6, 7, 8 pieces of shorter leading data, all pointing down. We had about 10 or 11 pieces of longer leading data, all pointing down, telling us that over the next probably a couple of quarters, over the next, say, 6 months, the economy is headed lower. Meanwhile, equities are headed higher. Something's not adding up. So if we continue to look at a couple ratios here, see what's happening in the market. So this is a dollar index. So it's a basket of cyclical currencies against the dollar. When the economy is in a growth rate upturn, these cyclical currencies are going to outperform the dollar, and this line would be going up. When we're in a slowdown, the cyclical currencies are going to underperform the dollar, and this line is going to go down, and the trend is still lower. If we look at the Russell versus the utility sector, right? Russell's very cyclical, utility is very defensive. Right? Russell is going to outperform during growth rate upturns. It's going to underperform during growth rate downturns. Still headed lower, still much lower. If we look at base metals relative to gold, this is a proxy for real growth. And if real growth is expected to head lower, we should expect base metals to underperform gold. And that's exactly what's happening. This trend is still lower. Yield curve, I mean, all across the curve, from the front end to the back end, is either flat or inverted. Okay, the front end is, parts of it are near inversion, parts of it are inverted. The 2 and the 5, the 3-month and the 10-year is almost inverted at 20 basis points. The popular 2 and the 10 is at minus 40 basis points. It was at minus 50, now it's at minus 40. Still, it's a deep inversion. 10 and the 5, 30 and the 5 still flat. 30 and the 2 continue to trend lower, now at minus 9 basis points. Right, so the 30-year is the most sensitive to growth expectations. The 2-year front runs monetary policy. We're inverted. Right, it's inverted. So this is an indicator that tells us the economy is headed lower. That's not supposed to be in here. Let's get rid of that. Okay, so looking at all the economic data, from monetary aggregates to interest rates, which have clearly slowed, which have filtered through to construction and housing, which are slowing, which have slowed down manufacturing sector production, right, which is starting to pull down employment. We saw that through hours worked, right? And as this gets worse, all those indicators suggest over the next 6 months, the economy is going to head lower. So income is going to decline, which is going to pull down consumption, which is going to pull down production, which eventually going to drag down employment. And then as employment falls, then that leads to less income, less consumption, less production, and so on and so forth. It's a cycle. And we're in this downward cycle right now. And it's telling us, all these indicators, that the economy is headed lower over the next 6 months or so. Yet, these indices have moved higher. Okay? If we look at, say, the S&P 500, a lot of people think this is the bottom. Stocks have bottomed, the economy has bottomed, and they're basing that off the fact that July's inflation data, CPI, headline CPI, fell from 9.1% to 8.5%, which was below expectations of 8.7%. So people think, okay, that's it. It's the peak. 1 month that's it. It's peak in inflation. That means the Fed's going to pivot. Maybe after September, when if they raise rates again, that's it. We're going to stop raising rates. We're going to have a soft landing, no recession, economy's bottomed. Boom. That's what's driving this market higher. It's a nice narrative, but it's not backed by any data. Everything we just went through to say the economy is heading lower is backed by data. Always take data over narratives. Narratives can create noise and they can create short-term moves in the market, but over the long term, asset prices follow the data, and the data says the economy is headed lower. So that suggests that this is not the bottom, and we're going to head lower in these indices. Okay. However, if we move to our technical aspect of this, if you remember, we're looking at these pivot highs and lows in the market. Okay. Price has broken this pivot high. I'm sorry, this pivot low. No, this pivot high to the upside. Okay, so we're in a downtrend, right? High, low, lower high, lower low, lower high, lower low. Okay, and now, boom, we just broke this pivot to the upside. So now we have a low and a high. So what we're looking for, if we're wanting to take this long, is a pullback to form a higher low, and then price to then form a higher high. So then we have a established uptrend. Now, obviously, this move is against the fundamentals. We want to trade with the fundamentals. Now, you can trade this, right? Absolutely, you can go long here. There's nothing wrong with that as long as you know that you're trading against the fundamentals. And eventually, this is going to head lower. You just need to be aware of that. So we want to trade in line with the fundamentals. So what do we need? We need signs that the market's going to trade back in line with the fundamentals, back to the downside. So what we would need is a pivot to break. So our pivot is down here. Now, if we waited for this to break, that's a lot of room, a lot of price action we have to give up. So maybe we look for some other things. Maybe we can be more aggressive. Maybe we get some type of reversal pattern. Right? Maybe we get this little M formation or a double top. Right? Get this double top. We break lower. We pull back to where we broke. And then we head lower. And as you can see, what did that form? A high, a low, a lower high, lower low. It formed a trend. So we can have that form inside of this move. That would tell us, like, okay, this might be the top. We're headed lower. We can be confident in getting in here because the fundamentals are telling us the economy is headed lower and these equities should move lower. The economy has not bottomed yet. So if we don't get something like that, we could get something like this. Maybe price stalls here, right? Forms a higher low, moves up, and then we get a break. Get this pivot break, right? And it forms a higher low, move up, it's a trend, and then boom, we get a pivot break. Then we'd be looking for a pullback to structure and be looking to get in on this lower, anticipating this lower high that's going to form, and then looking to take it lower. We'd be anticipating this lower high because we just broke this pivot low. We broke it to the downside, and now this move would be in line with the fundamentals. So you can get aggressive and get in right there, or you can wait for the pullback and try to get a more precise entry, reduce your risk, and increase your risk to reward. Okay, so we'd be looking for something like that. Okay, or if you really want to get aggressive, you can even drop down to the daily. Okay, let's say we got this price stalled here for a decent amount of time. We can call this a pivot here. Price starts to break these structures, right? These minor structures, or this pivot, so it breaks it lower. That could be a signal that this is our top, and price wants to indeed trade back in line with the fundamentals, right? Then we'll be looking for a pullback, lower high, and then we'll be looking to take it down. Okay. Now, if you're long, right? If you're long equities, there's nothing wrong with that. But if price starts to break structures down, even on the daily, that could be a sign that, hey, price is pulling back, right? Pulling back this way. And since the fundamentals are to the downside, that can mean, hey, this is the top. We're now going to trade back in line with the fundamentals. So price starts breaking structures and you're long, you might want to start reducing your risk or just outright take profit, right? And then look to trade it back to the downside, right? But we can get aggressive even here on the daily if price starts breaking structures, breaks this pivot, because it'd be in line with the fundamentals. The way things sit right now, there's no trade on the short side, right? I don't want to just say, okay, here we have this nice looking level here. Let's take that, right? Because we had a nice looking level right here, right? Within this pivot high. And what did price do? It blew right through it. The sellers didn't put up much of a fight. Price blew right through it. Could do the same thing here. So that's why I want to wait for structures or pivot or some type of indication that price is going to start trading lower again, back in line with the fundamentals. So you can keep an eye on this level here, and price gets into it. Let's see how it moves out of it. Maybe we get a reversal pattern, or we start getting structures broken on the daily. We'll have to wait. So we want to trade this to the short side because that's in line with the fundamentals. We're going to have to wait and see how price action unfolds in the coming weeks, couple months, however it is. We're going to have to come back to this, right? And as the dynamic changes, we'll come back to this and see if we can do something with it. And when that day does come, you're probably going to want to trade the Russell. Now, all these indices kind of look the same, right? But you're going to want to trade the Russell over the other ones because the Russell is the most cyclical. S&P, driven by those big cap tech stocks, it acts more defensive. It holds up a little better, right? Russell being the most cyclical one, it should underperform the most, right? So this is one we're going to look to get short, right? Is the Russell. So we're going to look the same patterns and indications I was just going over in the S&P. It's going to be the same here for the Russell. Okay, so reason we're looking to go short again is because all the longer leading, shorter leading indicators tell us over the next, say, 6 months or so, economy's headed lower, and that this move to the upside is not rational, is not in line with the fundamentals, and is not going to last. Unless something abruptly changes, which there's no indications of that yet, this move to the upside should not last. And what we're doing is looking for the technicals to move back in line with the fundamentals so we can trade this lower. Okay. I hope that made sense. If you have any questions, let me know. Throw in a comment. Find me on Twitter. More videos like this are coming in the near future. Okay, so look out for them. If you enjoyed it, like, subscribe, share, and I will catch you in the next one.